Well, I'm here today with Daniel from Prerequisite Capital Management, and we're continuing this discussion that we've had around some of the essential concepts. In our last video, we talked a little bit about the importance of protecting our wealth, but today we're going to have a discussion about generating investment returns. The question, I think, for a lot of people is, how do we generate investment returns, but in a conservative manner?
Yeah, so we covered how we are resilient in a complicated, changing world, and that'll protect capital, but at the end of the day, we still need to compound it at reasonable rates of return. Otherwise, what's the point? And so in order to do that, we'll sort of run through a few of the elements as to the way we look at markets and understand them, and get practical in terms of, in the previous discussion we talked a lot about capital flows and participant behavior and all of this sort of thing. So what does that actually look like in a market context? Now, one of the key points and principles that we need to be mindful of, and there's a lot of ways to kind of articulate this principle, it's kind of the idea of getting the initiative over a situation. So, and the initiative over a situation, so that situation or circumstance or even a relationship responds to you as opposed to you to it. If you're reacting to the circumstances and the environment, then you're a step behind. In a military setting, it's not ideal because that means you're basically being owned and controlled by the enemy. You're reacting. If you're ambushed, the solution is you need to attack. You need to regain the initiative, right? You need to be quite decisive. Hopefully you've trained and you're prepared to know what to do under different sort of conditions, but the idea is we need to get the initiative back so the enemy is responding to us. They are reacting to us. We're setting the tempo, we have the insight, we've got the training, the preparation. We can properly adapt in a timely manner to changing circumstances, and if we find ourselves in a situation where, well, we have been ambushed by circumstance, so to speak, well, we've got the initiative, we've got the training, we've got some tools to be able to quickly orientate as to what's going on, prioritize and execute in a way that we're going to get that initiative back.
Great.
And so in markets, a similar sort of concept is this idea of front running. Right, so back, if you're operating on a big market, making desk or whatever, you're on a trading desk somewhere and you have knowledge that there's, $100 billion is going to trade in some market, for example, but it hasn't yet traded. It's either going to buy or sell for whatever reason. Part of what they would do is front run that information, and they'd place their own trades before they go and place this, in anticipation of this huge market order hitting the tape, so to speak, and they would profit on that predictable move, so to speak. Now, obviously what we do, we take that similar sort of concept of front-running behavior of participants. Obviously, we don't operate with inside information. We operate with macro-level, publicly available information, but we analyze it in ways so that we can dissect and discern what is actually really going on beneath the surface of any given market. So beneath the surface level of price, we're seeking to gain deeper insight as to what is actually happening from a market structure, so flows and participant behaviors and vulnerabilities, liquidity or the lack thereof underneath any given market, in order to identify higher probability points of insight that we can kind of front run. And the idea of front running is kind of important in a trading concept. Not that we trade in our mandates, we have a longer term time horizon, but we do need to kind of balance, like lean into certain trends or asset classes at different times and slightly lean away from others at different times as well. The idea of front running has an element of timing to it as well.
Absolutely.
So in markets, if you're way too early, that's kind of the same as being wrong. Even if you eventually be right, because the market moves, can you handle the losses or the drawdown while you're waiting to be right? At the same time, if you're too late to the move, well, the move's already happened, and that's not ideal either. You kind of got to be half a step ahead of the broader movements or swings, and so if you can gain some insight as to what is actually happening beneath the surface of any given market in terms of participant behavior, flows, sentiment, critical mass conditions, whatever the structure is happening underneath any given surface level trend in a market, you have half a shot at, making slightly less bad decisions than everyone else. Or, more often than not, you can do okay in terms of leaning into or against particular market trends at different points in time.
Yeah.
And that's important because, even though 60%-ish of our returns are driven by just simple diversification principles and a few other simple elements to how we skew asset classes, we still need to dive more deeply into how the system is structured and how these money flows and capital flows are behaving in order to be able to still skew at different points or skew into certain securities or asset classes or industries or currencies or whatever, in order to kind of, in a conservative way, increase the compounding of returns. Now, even over an investment time horizon, the idea of front running is important as well, like a longer term, and it applies to every realm of life. If you're leading a situation, you need to be a couple of steps ahead of your team or the event or the circumstance. So you can help even your team be a step ahead of the circumstance, so they have the initiative over that realm, or even in a relationship, or even, even with my kids, you can predictably anticipate, if they're at a certain age, 2 or 3 years from there, they're going to start to run into issues of like peer pressure or whatever. You can front run that issue and basically equip them and process through whatever the issue is in an appropriate way ahead of time, so they don't succumb to that ambush, so to speak, or that new issue. They're already pre-equipped. They're orientated with the right understandings. Exactly. They have the principles, they have the perspectives. In fact, they're analysing their friends who don't understand this and feeding it back to you as to, almost how smart they are from their point of view. But this same principle applies in all of these different realms, and then you're always got that one step ahead.
Yeah, great.
But it's the same concept.
So bringing it back to the markets, which is the area that you operate in, we understand that this principle requires us to have an understanding of things that oftentimes are simplistic in nature, but a lot of people miss.
So even just being able to observe clearly is important, and distilling all of this stuff into a more objective way of looking at things.
Right.
So a data-driven methodology, it's being able to distill an abstract concept into a measurable data-driven model or behavior or indicator or something is invaluable, because it helps us to become more objective about the world, less susceptible to biases in thinking or whatever. And if everything's trapped up in our head, I perceive this is going on, and if the conditions actually change, but you've fallen in love with your insight or your perception or what you think is happening, you might miss that change in condition.
That's right.
But if it's data-driven and it's out of your head, you're like systemizing the routine so you can focus on the important exception or the strategic stuff. But you can see when the conditions change, because the data is very clearly changed. And in our case, because we publish so much of our frameworks and our data sets and our models and things, if conditions change and the data changes relative to our pre-existing sort of benchmark of a view of what might be unfolding, our clients well and truly let us know, but we see it anyway. But it helps us be more objective and a little bit more humble about the way the world could be adapting. And then if we're out of line with conditions, well, it enables us to adapt in a reasonably timely way. So in the scheme of things, it's a non-issue, even if we're completely wrong-footed in some sort of at the margin type balancing into or away from some particular asset class. And the strategy we have is very forgiving of that sort of misalignment anyway, because we're so resilient. And so it's kind of gives us the ability to be patient and to be disciplined in watching conditions unfold. And if we do realize, or our process starts to give off signal and indicate that we need to realign, well, we can do that in a relaxed manner too. We don't have to be hurried. We can sort of assess and act more decisively and with greater conviction and discipline, and realign even to conditions. And in the scheme of things, we still achieve the portfolio objectives we're shooting towards.
So one of the principles that you've talked about and we've talked about that sort of underpin this is this idea that aggregated human behaviour doesn't really change, but there is a predictability.
Yeah, so any given individual is in some ways a little bit less predictable. They still have free will, and past the point, you can anticipate their probabilistic behaviours in different circumstances if you know them well. You know the way they're wired and their precedents and different experiences in life. When you collect a group of people into more of a crowd type dynamic, besides the IQ collectively dropping and everyone becoming a little bit more emotional, they become much more predictable.
Right.
In complexity science, there's a concept of emergence or emergent behavior where you can get a group of individuals or individual components, but when they're integrated together around in some form of a system format, they develop a very different and potentially quite distinct collective emergent behavior to them than what they would be individually separated. Yeah. And so that enables, and especially once you start to understand the very core nature of human nature and incentives and all of this sort of stuff, a degree of predictability. They don't become perfectly predictable, but you can usually anticipate the way different crowds and participant groups will react to different circumstances. Now, in a lot of the literature and across a broad spectrum of fields of study, and especially throughout history with a lot of experienced sort of old heads writing about their understandings and learnings of the world, especially in markets or investing or business, they talk about how patterned behavior is. People are people, whether it was today or 3,000 years ago or whatever. Same sort of human nature. It's just slightly different technology or societal setting or, legal regime or political organisation or whatever. But people are still people. Now, about 20 years ago, when I was kind of really starting to come into this field of becoming intensely interested about the world and markets and investing and things, a couple of the old guys that I was studying who operated more in a trading type, 3 to 12 month sort of time horizon, and they were using things like the commitment of trader reports or sentiment surveys to sort of better understand participant positioning and the way positioning and sentiment and the way people behaved and interacted with different conditions and pricing of markets and all of this sort of thing. One of the things they observed, and even back in those early days, anyone who has really studied markets and especially the relationships around sentiment surveys, and some institutions release money flow statistics from their broader client bases or networks, or participant positioning in commitment of trader or COT reports in the US, there's a sense of deja vu that keeps happening, whether you're looking at a corn chart or the Canadian dollar or some bond market, and the way positioning and sentiment tends to behave relative to the pricing progression of any given market. They used to theorize that you could synthetically approximate or proxy that participant group behavior just using the raw inputs of price and volume sort of information that any given exchange will make freely available publicly, and through a volatility lens and different things. They used to synthetically try to recreate these cotton and sentiment survey type behavior patterning just using price and volume and volatility as an input. But they never quite cracked it, and then seeing their example and also agreeing with them and having the same sense of deja vu with watching people and participant behave in just such a repetitive pattern manner relative to different price constructs and market happenings, I'd try every year or two to run down that rabbit hole and playing with data, trying to create that synthetic or strip out those synthetic behaviors of those different participant groups from that primary information that any exchange would release, with total failure for years and years and years. But, being young and over passionate and whatever, I'd still every so often come back to that and try to figure it out. Chipping away at it, trying to create sort of a model of a particular dynamic. Took the kids to the beach, down the beach, watching the kids playing in the sand. And, when you obsess about markets and how the world works and all of this sort of stuff, like you're a walking encyclopedia of charts in your head. You just see stuff and data and whatever. And I'm sitting there, I'm like, I've seen that picture before. What was that? Where was it? Oh, that's the oil commercial, commitment of trader positioning set, as you do if you're obsessive and a bit weird about markets. Anyway, I got home and I pulled it up and pulled the COT data up, and I'm like, bugger me, that's it. And so you sort of stumble across this stuff, and then you reverse engineer as to why that works and the principles embedded. Anyway, long story short, I'd stumbled across how you synthetically capture that behavior.
Wow.
And basically separate out of that fundamental, price volume volatility mix, the behaviors of the different participant groups.
Wow.
And after that shoe fell, then the next shoe was the speculative sort of group.
Yeah, that's right.
Which you just slightly rearrange some of the principles at the very core of it, and then you end up with that. And then when I'm pulling that sort of this new synthetic model, which even today has the exact same parameters in it as what I first stumbled across, because I still built, I'd studied so much psychology and behavior, that even in what I was building, I was embedding into the algorithms what the behavioral principles that keep coming through time and time in all of these different fields. It's still the same parameters today, and so I could drop, whether it was the core market or some currency or some bond or equity or whatever, through these models and basically be able to reproduce the COT reports, the sentiment surveys, all of this sort of thing.
It's incredible.
And the funny thing was, and you can see it in a lot of the history of these charts, and especially if you've seen any of our research, you can go back massively in time, before a lot of this stuff even existed. But then when these surveys or COT reports come into play, with the benefit of hindsight, when you look at, say, a discrepancy between what our synthetic stripping out of behavior of groups are from that data, the raw data, versus what the actual sentiment survey or COT report actually reports, when there's a discrepancy and they actually diverge, it's like, with the benefit of hindsight, which one would you have wanted to have taken signal from? Well, it's not, to my surprise, the sentiment survey or the COT report or the flow data set from some institution. It's actually the synthetically derived behavior from the raw data.
Wow.
Right? And then I even found that it translates even over into dark pools, which is off-exchange trading, is particularly in stocks and things of different and over-the-counter markets and all of this, and it works that way because there's still an arbitrage mechanism that reconciles even dark pools or over-the-counter markets back to their exchange-traded brethren, so to speak, or siblings. And so it's still the same behavior patterns. And so I'm like, fantastic. I've now got an apples with apples ability to compare any market or any stock or any currency in the world, the relative positioning and flows. And the other big light bulb moment was when I realized that if you strip out of the fundamental data sets, the speculative community behaviors and flows and the patient money community behaviors and flows, the residual is actually the underlying liquidity, or effectively the more passive, non-direct, like active or analytic participants. So it's kind of like saying, what does the broader world or the complex system that market's embedded within think of this market? What demand is it placing to it? What money is going into or out of that particular market? So you can see, you can see the inherent strength or weakness of any given market with the liquidity that underpins it. And even that underlying liquidity dovetails brilliantly with all of the more conventional academic measurements or hindsight measurements of liquidity conditions in equities or whatever, whether they're talking about, order book depth or bid-ask spreads, or all of the different varieties of ways of trying to, on a hindsight basis, measure, or even in a real time, which is hard with the data availability. Liquidity, it dovetails with it brilliantly. And so that was all very surprising to me, and that set a series of dominoes in motion to being able to measure and map flows and positioning. Yeah, we can see beneath the surface.
In an objective, data-driven manner.
Correct. And we can compare apples for apples, because like COT reports are only on a very small subset of US futures markets. And even COT reports, they work great in the US futures markets that trade currencies and commodities. They're not too good on fixed income, and they're really noisy on equity markets. And so the COT reports are incredibly limited. You can't compare them with a sentiment survey of some European equity index. And even sentiment surveys are problematic because they're just a small sampling, and what sort of questions and how's the framing of the questions influencing the result. And it's really problematic. And the same with institutional fund flow surveys. You've got sampling issues, and are there any biases? Reliability and release of data, in being able to extract all of this information out of, price volume volatility type, which is all just publicly available anyway. We have timely data metrics independent of government agencies releasing data or certain institutions releasing data, so we're more independent. We're not beholden to pick a government or pick an institution or whatever who can shut off data supply or corrupt the integrity of data that they're releasing on surveys or flows or positioning or whatever it is. And so it's sort of this, by accident, solved a lot of problems.
So you've built this incredible set of tools which give you the capacity to gain that foresight, so to speak.
Well, yeah, it helps us see into a situation.
Yeah.
And if you have greater insight into a situation, it naturally does give rise to a degree of foresight. It's not a perfect ability to predict things, but at least you can understand where it's come from or where it's really at.
You're seeing clearly.
Yeah, and it's like if you can see that everyone's on the same side of the boat, then clearly that's either going to tip or we need to rebalance in the other way. Like you can see a point of vulnerability, so to speak.
So how does this work in some real world examples for us?
Yeah, so there's a variety of different tools and data-driven applications of a lot of these different things, and expanding on some of the learnings, that we've kind of just run through briefly. One of the most important things to understand, though, any given tool, it's so the analogy I often use is like people and leadership, right? So every single individual person has strengths and weaknesses, particular skill sets, or whatever. A good leader will be able to bring that group of people together and unify them in such a way that the group gets the benefit of their skills and their strengths, and all of their individual weaknesses kind of just disappear, right? And so the group becomes, greater than the sum of the parts, and that's good leadership. It's the same with tools, where any individual tool has strengths and weaknesses to it, might be somewhat like highly useful, but still imperfect in isolation. But when you have a toolbox for different things, then all of a sudden it becomes very useful, and you can build a house. It's like the old saying, to a man with a hammer, everything looks like a nail. You can't build a house just with a hammer. But a toolbox and a variety of different robust, unrelated tools and applications and solutions help us. And so that looks like, in a practical sense, a variety of the different tools that we've been able to just evolve from simple first principles. So one important aspect, or one important tool, like when a market is functioning properly, it'll have a diverse array of participant opinions and activity. Basically a lot of disagreement in there, because that's what makes a market. Right. Some people will think this will go up or down, or these are the conditions, or this is the underlying reality, and there'll be a lot of disagreement in there, and that's a pretty healthy, liquid functioning market. When diversity in that group drops and everyone starts to become quite unified, either in their opinions, their trading strategies, their investment positions, in their exposures, that marketplace actually becomes less liquid and actually more vulnerable to a turn. All right. Now, there's a few different studies that have been done that sort of highlight that core basic dynamic. This is the decision rule dispersion function down here, and the above part is market price. So for whatever market this is, doesn't really matter, but this illustrates the point. We have a higher dispersion of views and opinions and positioning and time horizons and all of this sort of stuff. And whereas when it falls, this means it's more unified. So everyone's had similar experiences in their positioning exposures, or they've kind of clustered together in similar unified views of a particular market. And when you get greater unity in all of that positioning and views, and the liquidity starts to really become vulnerable, the market becomes vulnerable, it's highly likely you're going to get a turn.
Yeah.
Right? And that's when we saw the turn in this particular thing, and once again. And so this whole concept is one of the ways of understanding, one of the tools that we've developed, which is this liquidity turning point signal approach. Now, this is mathematically defined. It sort of draws on a lot of basic first principles of human behavior and market structure and all of this sort of stuff. But when we get these signals trigger, it's like a greater than 70% probability that it's a change in trend, or at the beginning of a correction, or whatever. And so it's just like the way we use them, it's like in a jungle warfare analogy. If you're in a platoon and you're in enemy territory and you're in the jungle, then at night you're going to be setting up tripwires everywhere with flares and claymore mines or whatever it is, in the event that an enemy comes through at night and you're aware, you're alerted.
Yeah.
And it's the same sort of principle here. It's not like these tools kind of are at the beginning of our research and inquiry process as to what the pricing structure is at any given point in time or under any market. But like a flare is triggered and gone off to go, hey, just beware, you might need to look into this circumstance. The soldiers don't know whether it's an animal that's wandered through to trigger the flare, or whether it is the enemy, but they definitely need to be onto it.
Heightened alert.
That's right. It's just like these things. We know it's a high probability of a turn or a changed market structure. And so this is quite helpful at different points in time, as you can kind of see. And so this methodology works across any market or any stock, which is kind of useful. And it helps us, when we can glimpse reality through a multitude of different perspectives, all unrelated, but all useful and robust. And tied to common sense. And if we can see that same reality, the same picture coming through, we have a greater confidence and conviction that we're actually observing reality accurately.
Yeah.
Right? And that can actually be quite a competitive advantage in its own right.
Absolutely, yeah.
In a world where, we're awash with information and noise and all sorts of stuff. It's like we have more data than we ever knew what to do with. We just don't know what to do with all of that data, and we've lost that capacity to generate that deeper insight into things because we're so fast-paced. So here we're triggering, we watched this build for a month or two before it finally triggered, and at the same time we've got this flows condition. So these are those flow tools that we're talking about, stripping out participant behavior within or underneath any given market. So the speculative crowd are well and truly overdone. Quite a speculative ramp. Underlying liquidity is not confirming the health of that run-up. And we've got the patient money crowd selling into this. Yeah, exiting, distributing at the margin, away from that equities allocation, basically. So this is the world share market, and this is the end of, or transition into 2019. And so we've had the trip flare signal. We can see we're in a vulnerable condition. And so it's like, obviously this sort of insight generation ability is very useful. Now, in our conservative mandates, we're not trying to time markets and pick tops and bottoms and all of this sort of stuff. But this does definitely inform where risks are, opportunities are, how we need to lean into or against certain markets at different points in time. It's like if a client goes to a normal advisor or an investment manager absent this sort of capacity to see beneath the surface. You know, if they come in here, they're not aware that we're basically having the flares trip to, hey, this is high probability of a turn, not certainty. And it's interesting, by the way, just to backtrack, when these things trip and price doesn't respond, like so the 30% of the time where it appears like it's a signal failure, it has information content in its own right.
Right.
Because it signals the fact that, man, even in this critical mass condition of positioning, where everyone's on the same side of the boat, price is not sensitive to that at all. It's just steamrolled through it. Hasn't even missed a beat. And that attests to the inherent underlying strength of trend.
Right, yeah.
So even that has signal value to us, you know. Anyway, so come here, they're not aware, you know, they approach the advisor, want to get invested into whatever, probably because they've heard good things about the share market from their friends, not aware of the signal, like the critical mass conditions, not aware that liquidity is starting to trail off and weaken underneath the pricing structure, not aware of the over-speculative condition, not aware of the big money, patient sort of institutional distribution that's going on. It's more likely than not to be an inopportune time to be stepping into the share market or pick an asset class. You know, it's not like you bet the farm on this stuff. I mean, in the future, a lot of our investment process and research process, and a lot of these tools lend themselves to a more aggressive portfolio strategy or product. Yeah. But at the moment, you know, our focus is more on providing resilient, consistent compounding of returns, which is pretty essential in the environments we're in and going into. Yeah. But all of this stuff, you know, we have clients that engage us on a research and consulting basis, and they run a lot more aggressive mandates.
Right.
And so they're able to, you know, take a lot of this information and express it in their contexts. The other thing to note is that, you know, in the speculative crowd, they're very much momentum driven. They're just following price, but they're prepared to use leverage. You know, this is kind of a good gauge, if you step back, as to where the narrative is at in any given market. You know, is it getting overdone? And you sort of triangulate a lot of insight just from seeing how the flows are behaving relative to what the prevailing narratives and memes and different psychological states that are out there in the different participant groups. Same in this area, we can see what the larger money, real money, so non-leveraged, longer term horizons, like institutions, pension funds, endowments, family offices, the works, how they're perceiving the fundamentals under any given market, right? If they're perceiving that price is too high relative to the underlying fundamental value of that market, then they'll be distributing. They'll be selling into that at the margin. If they see that price is actually completely way below what is underlying fundamental value, they'll be accumulating, like buying into that market. And so you can kind of see now the patient money, that more institutionalized real money type participant crowd, they're not necessarily beholders of truth. You know, when they accumulate and they get trapped and they get, because you can see the levels, the price levels, the market levels at which they're acting, especially on mass. When they get trapped and price goes below them, that's where you get a cascading or a crashing market. Right. So you can see those thresholds where, if crossed, they're going to be forced to unwind, and you get this cascading dynamic both on the downside, and it also works in reverse on the upside, right? And so the sort of insight we can triangulate is really helpful.
Of course, and it gives you the ability to front run.
Yeah, that's right. And so this is just a quick example of like the patient money positioning under the US dollar index, and this is the actual COT data set. And so, you know, it's just it just sort of highlights that fit. So this is synthetic, whereas that's the original underpinnings. And sometimes when it diverges, you know, the signal, like here, is, with the benefit of hindsight, was more accurate from our synthetic behavioral tool than the actual underlying reporting COT. And this same picture is under a variety of different markets. This is copper, this is a speculative crowd in red. So that completely missed this major peak, right? Anyway, and so even underlying liquidity tends to sort of front run. So this is sort of like a proxy of the real conditions in that broader complex system and the real demands for copper, you know, and you can see the liquidity really taken off before it's really even recognized by participants, and vice versa. Liquidity just disappears and weakens substantially before you even see it in price. Right. And participants were still unaware, basically. And so you can start to see the inherent weakness or strength or vulnerability of a trend or sustainability of a trend. Even here, liquidity was flagging. The run-up was entirely speculative. That's a very weak condition. That ended up being a peak, and it's kind of flagged and, fallen off. And so, insight into the present can give rise to some probable foresight that is actually quite helpful when you're running portfolios, is to identify risks and opportunities. The other thing that's fascinating, because markets are a discounting mechanism, they take all of that world of complexity and collapse it back into price, right? It's something that we can't do as humans because, and this is what every macro analyst or even investment analyst kind of has a degree of hubris about, whether they realize it or not, probably myself included. We're trying to take all of these macro variables. We assume that we can even identify all of the variables that matter, like underneath the US dollar or underneath pick a analysis target. We can identify the variables, we can which is problematic, right? Because there is a lot of variables in this complex, kind of complicated situation, lots of moving parts. Can we identify them all? Can we properly assign proper magnitude to all these variables? No. We didn't even know where to start half the time, and was this variable more important than that when it comes to this, in this context? This is not easy. What about the interrelationships and interdependencies that can come and go between all of these different variables that we're not sure if we've identified them all or how important they are? What about the relationships and interdependencies which can come and go depending on the system and the broader context? And then how do we account for emergent behaviors when the combination of all these variables combine together into something very different in how it behaves and functions in the global system or in some sort of an ecological sense from the components of its parts? And the list goes on. And so it's quite an ego trip to think that as a macro analyst or as an investor or all of this sort of stuff that we can even figure all of that out, right? But then part of the sort of solution to that is to realize, well, that's actually what markets already do for us, right? So why are we trying to be a market? And then when you sort of understand that, it's well, then also if we can see flows, right, then that's we have the benefit of how these core participant groups are actually understanding all of what they're seeing too. Now, one of the important points is every participant group has a different proximity to information.
Yes.
Right? Yeah. They have different incentives, different experiences, different objectives, and all of this. And one of the things that I realized early on in studying behavior and psychology and all of this sort of stuff, and then it's expressed actually here as well, the best way to categorize people and groups, especially in markets, but this even across the board, is actually according to motive. Right? It's at the level of motive that you can start to really categorize. And so that's why we're talking about a speculative motive and a patient money kind of motive and all of this sort of stuff. It's, once again, it's a biblical origin. In the Gospels, it's all of a sudden we've got Jesus talking about and helping to gain deeper insight into core dynamics of behavior in society and people at the level of motive.
Yeah, absolutely.
Right? And so, it all tracks back. And so there's a variety of common sort of archetypes of behavioral groups, which we'll probably talk about at a different time, but they all have different proximity to information, different ways of acting, different cyclical relationships. Some groups tend to operate counter-cyclically, others are in line with cycles, others have, it's a variety of different things. Some are informed by career risk, right? If they don't follow the herd and do what's fashionable in their industry or in their amongst their peers, they get fired. And so that forces a very cyclical, so they're always doing the wrong thing at the wrong time at the extremes of the cycle and vice versa. Or if you're naive and inexperienced in markets or whatever, then you're probably also doing the wrong thing at the wrong time you're going to be caught up in this speculative crowd when everyone's optimistic, or pessimistic to extreme, because this market's only going to just keep collapsing. Obviously, everyone knows it. So you don't want to buy, you want to be selling still, which is what they're doing. You know what I mean? And so you can sort of start to triangulate what's really going on out there, and so you're starting to play the players as opposed to, and just watching the behavior of the different groups, you can triangulate what's actually going on in any given commodity or currency or industry area. And in fact, this is what that gets to in this next chart. So we've done this under a few different industries where we consolidate the flows. In this case, this is in Australia and the big four banks in Australia. So the participant money flows, speculative patient, and then the underlying liquidity conditions underneath the combined, CBA, Westpac, NAB, and ANZ. When you aggregate an industry like that, all of a sudden you start to have coincident and leading and real-time information on important key drivers of their profitability and prospects and all of this sort of thing. And as an example of that, so if you understand our Australian banks, especially for the last decade or two, our banks are so overexposed to property lending, it's ridiculous.
Yeah.
It's north of 60-something% of their assets are related to property lending and exposures, when the international average is more like 20-23% or whatever it is. So hyper dependent on all that. And so their share price rises and falls with the prospects around property and lending and the different components. And it's fascinating that, say in dark blue here is basically the total aggregated. So credit leads property prices, right? Especially when you're in sort of excessive credit conditions, over leverage conditions, all of this sort of thing. The more credit out there is that are underpinning the property sector, the more, so it typically leads anywhere from 6 to 12 months. You change the credit flows and aggregates and conditions, and then 6 to 12 months later you see the pricing of property in general responding and moving as well. And so the speculative money flows under the banks perfectly match the investment credit that's being extended to investors across Australia. And so whereas this is a leading index that only goes back to 2002, we have this all the way back, right? And we can see in real time the realities of what's going on. The underlying, so all finance conditions tend to be represented by the underlying flows, to those stocks, because that drives, because the more credit they lend, the more profits they make, and et cetera, et cetera. And so we have real-time indications of all this stuff. Even in the banks, if you understand, there's still an Achilles heel to our Aussie banks of international funding market dependency for a variety of different reasons. Now it's reduced a little bit since 2008, but it's still an Achilles heel. And surprise, surprise, the patient money flows perfectly match the spreads on that sort of wholesale, internationalized, money market sort of funding proxies and stuff. And so, but whatever the industry, whether it's the construction building industry or whatever, we're finding these similar dynamics where we have often leading insight at all the key junctures as well of underlying business health and conditions. So that gives you insight on the pricing of these securities, sectors, revenue, prospects, the whole works. So it's fascinating how this then further cascades. So we have three-dimensional insight into things that to everyone else, they just have surface level.
Yeah, that's right.
And we're following the behaviours of people, because even though I've talked about how complicated the world is that we have to navigate, we don't know the variables, don't know the magnitudes, et cetera, we still have to make decisions in that world that have consequences.
Absolutely.
We still have to, manage our savings to try and preserve them and compound them. So we're still forced to have to make decisions, even though the task we have is ridiculous, in light of the complexity. But that's why we default to all of these common sense principles that underpin resiliency.
Yeah.
These default to these principles and tools and methodologies that we've sort of evolved out of necessity to try and front run and just have a bit of an understanding of behavior at key points and the health of trends and all of this sort of thing. We previously talked about how policymakers are disengaging market mechanisms, from counterbalancing excesses or issues or whatever, or creating excess liquidity from the wrong source, and that's going to go somewhere. So we need to track money flows more than we ever have, and all of these sorts of things. So, this is another example. This is a speculative community. You can kind of triangulate different opportunities of when you want to actually be big in a market and when you want to be small, and obviously these sentiment washouts where interest rates are only going to ever, or yields are only ever going to keep rising and bond markets collapse, usually is the best time to buy them. And this is 2018, which was similarly a great time to buy them. They've gone north ever since. Now, even though we have this capacity to generate insight, we still don't get too carried away with trying to, we don't want to have our returns dependent on our ability to predict the world.
Right, yeah.
Because especially when you're managing a lot of family and friends' money and now clients who effectively become family and friends when they become clients, you still need, or I need to still be able to sleep at night, and not have to have all of the performance of these portfolios dependent upon me being a rocket scientist or something. And so that's why we lean so heavily on common sense principles, diversification, and just lean at the margin with all of this sort of deeper analysis stuff.
At the same time, those common sense principles and sometimes the ability to see into these things and have insight positions you well as a group. To be able to have the foresight to make decisions.
Well, that's why we've been able to steward these portfolios in a way where they are so consistent and the volatility is so low and they're not correlated to any other sort of strategy or market, really. And we've kind of achieved and are achieving the return objectives that we have.
It is such a unique and I guess investment solution for people. Investment option for people as a company, and I guess we've talked a little bit in this video about being able to front run and how we can generate investment returns in a conservative way. We're going to take some time in the next video that we're going to.
So this one's all about front running behavior in a sense. So we need to understand the way people and participants are behaving. See the money move, identify critical mass conditions in markets where they could be vulnerable, and triangulate that with underlying conditions. So what's going on at an economic level with growth, with inflation, with broader issues that are affecting markets and the way the world is evolving. So this is more about front-running capital flow and behavior. The next sort of set of things we'll go into is front-running underlying conditions in economic cycles, and this gets into more traditional sort of leading indicator type concepts, but it all just adds to the toolbox to get that three-dimensional view of what's going on. I mean, there's a lot of other different tools and insights and all of this sort of stuff, and we've actually produced a nearly 100-page sort of portfolio construction guide, which actually goes into much greater detail in all of this stuff. So people who are actually interested in can actually dive into all of these things even further, which you'll find a link on our website too. But even actually one that's worth mentioning is just even when you understand how to strip out flows and behavior and participant groups and even strip out core dynamics of what's going on, I can start to see and develop practical tools to develop real-time insight into credit risk pricing models underneath stocks or industry sectors or markets. This is those same banks that we were talking about before. So this is the fixed income market credit spread, so credit risk in terms of lending in different ways to the banks in Australia. These are their spreads. This is our capital market implied credit pricing risk sort of model, which is kind of like a proxy concept to a credit default swap, which is a whole nother discussion, but it basically is real time, right? We can strip this out of capital market pricing for the different securities, but it tends to coincide or even lead at key junctures actual fixed income market spreads, and so that's pretty useful information to have
absolutely.
to triangulate, well, what's really going on with a stock or an index or a sector or whatever. But necessity is the mother of all invention, is the saying, and like in wrestling with all of this stuff for so long, you kind of have to create solutions.
Yeah.
And fortunately enough, we've stumbled across a few that are reasonably useful. The next video will talk about how we gain leading insight into some of these underlying. So, like in the resiliency discussion we had before, we talked about everything mapping back to growth, inflation, and capital flows.
Right, yeah.
So obviously leading indicators of economic activity or inflation or even capital flows, with some of these starting to get into the category of leading indicators on capital flows, but we have some other ways of triangulating that. But some of this front running of underlying conditions in these factor progressions, we'll talk about next.
Great. We look forward to that next discussion, and thanks for your time today, Dan.